Too much, too soon? An examination of the use of HECM proceeds and product design. Welcome to the Industry Leader Update. The recent overhaul of the HECM program was a watershed event for both the reverse mortgage industry and also senior homeowners alike. The elimination of the standard fixed rate, a consolidation into one product, two-tiered upfront FHA premiums, and first-year distribution restrictions. All of these were born in FHA's attempt to rein in the HECM program back to its original intent while reducing the risk of defaults and payouts from the MMI fund. Now, the idea was to prevent borrowers from using all of their proceeds in the first or early years of the loan, which could have them with little or no financial options once they've exhausted all their proceeds. Also, lower upfront withdrawals and deferred or 10-year payments or a line of credit reduce the likelihood that the loan balance would exceed the home's value in the early years of the loan or when the loan ultimately terminates. Now, most program changes were spurred by the CFPB or the Consumer Financial Protection Bureau's report to Congress on the reverse mortgage program. In the report, they specifically addressed the problematic standard fixed rate and the required lump sum that came along with it, and its ultimate impact on both borrowers and FHA. Now, while we find ourselves with both a new product design and an economic landscape than we did in the years 2009 through 12, we should still exercise vigilance. Vigilance against promoting borrowers taking their proceeds in the early years of the loan, and also in vigilance in protecting and improving the HECM's public image. Now, certainly some borrowers do warrant the maximum use of proceeds in the first year due to mandatory obligations which exceed 60% of the principal limit. But what about those who have funds available after the first year distribution restrictions expire? Should these individuals be taking the remaining funds? Now, recently our industry has seen the introduction of two new fixed rate products. One automatically pays the borrower the remaining proceeds the day after the 1-year window has passed. The other allows a choice of term, tenure, or a line of credit. Now, these products address the desire of the public and senior homeowners to secure a fixed rate loan versus the uncertainty of an adjustable rate. But this is where product education is key. Is the increased cost of the fixed rate really worth the higher interest rate? Or should the borrower plan on utilizing most or all of the proceeds in the first year? Now, this requires a higher standard of knowing our collective borrowers' goals, finances, and also their challenges. It's a tightrope between giving the consumer the fixed rate that they may want while also avoiding promoting the early use of all proceeds in the early years of the loan whenever possible. Now, all options must be presented to the borrower, including the fixed rate loan and the advantages of deferring a line of credit or 10-year payments for increased future benefits with the adjustable. Now, what are your thoughts? Should we be concerned in promoting or limiting a borrower's burning through their cash too quickly in the early years? And how do these new products impact our industry's goal, both to serve and protect the borrower? Leave your comments in the comment section below and have a great week.